Good afternoon. It's the afternoon of Tuesday, the 14th of July in New York City. Nice warm summer day. CPM Group has issued a new short-term trade recommendation today. A few weeks ago, we had said we thought the price was going to fall before rising. And we got to within $1 of where we thought the price would fall to on a short-term basis. It bounced back. You may notice if you read our trade recommendations that we used to have a footnote that we said that within 50 cents of our target, we thought that was an accurate call. We've actually increased that to $2 because of the increased volatility and higher prices that we're seeing in gold prices. And we may actually change that further. We're discussing what kind of discretion we should allow ourselves to say, hey, we were right or we were wrong, given the increased volatility in gold prices. Right now, the gold price, as we issued this the trade recommendation around noon today, the price was about 1804. We said that we thought the price could get to 1825, which is no big stretch because it touched 1825 about 5 or 6 trading days ago. We have said in recent times that we do see the price going higher, but over the next 5 days, which is pretty much the extent of the trade recommendations horizon, we think 1825 is a good short-term target for short-term in and out investors. Longer term, we continue to think that the gold price is going to rise. We have been on record for many years now saying that we thought that the gold price would probably rise to record levels on an annual average basis, but possibly not until 2023, 2025. We still hold that view. We're publishing some work and working with various clients, advising them on what we think is a reasonable outlook for gold prices on a longer term basis, and also talking to them about why projections that you're seeing for $3,000, $4,000, $5,000, $10,000 gold really don't seem to be based on reality. Oftentimes the commentary that you see behind these really high projections evinces a stunning lack of knowledge about how the monetary system works today and how financial markets operate, as well as basic economics and the political realities, not only in the United States, but on a global basis. And also they tend to show a tremendous lack of knowledge about the price elasticities of supply and demand. What happens to mine production, secondary supply, fabrication demand, investment demand, central bank buying and selling as the price rises? You have 1.3 billion ounces of gold, or more than 1.3 billion ounces of gold in the hands of investors right now. You have another billion ounces in the hands of central banks. A lot of those investors bought gold at much, much lower prices, $800, $900, $1,100. Price goes to $2,000. Some of those folks will take profits, especially if the price goes to $2,000 in the midst of a crisis, and those very people who had bought gold earlier are using that gold to survive the crisis. So there's some natural breaks in the gold market that keep prices from rising too high and staying high when they do rise high. We've seen this before. We saw it in 1974, we saw it in 1979, 1980, 87, 93, 94, 95, 2001 to 2011, and we'll see it again. The price can rise, but for a variety of economic and political reasons, as well as for the natural economic nature of the way the gold market works, prices cannot rise to unsustainably high prices and stay there. And the investors who understand that take their profits and do well and reposition once the price comes down. And the investors who don't understand that sit there and say, boy, I was once very wealthy. Anyway, we're doing a lot of work on that because a lot of people are asking about it, and I wanted to mention it, and we'll talk in a week or two when we come out with our next short-term trade recommendation. In the meantime, stay cool, stay healthy, keep your hands washed, and stay away from people who don't look like the Lone Ranger. Bye.